Welcome to TheoTrade. This is Don Kaufman. It's April 25th, 2025. Just about 30 minutes to go to the cash close on what is once again absolutely wild week. You sell off huge on Monday. We rip back throughout the course of the week. I mean, this is, again, it's just absolute chaos in this marketplace. Look, yeah, we recovered, but that recovery is under fire. Like markets, yeah, they rallied, but there's still critical and looming risks. Let's actually kind of break it down for you here in, again, this TheoTrade weekend update. So right now, as we come into this cash close, and one of the first things I'll point out, there is no volume. Like no one seems to want to participate right now. The S&Ps are up some 29 handles, but like we're looking at like 1,000 contracts a minute, which is weird. It's just weird. You're like, well, why? This is unusual on the kind of volatility, even for today's trading session, which you're like, oh, it's not that volatile. Please, we traded 54.80, then we traded 55, 54. Oh, I don't know, what's 70, 80 points amongst friends? I mean, there's a lot of weeks, even months in my trading career where we didn't move, 70 or 80 S&P handles. And here we are, doing it every couple of minutes. And today was also one of those days. It was kind of a tweet happy day. We had sold off on it, but it's, again, it's tough to want to engage. The marketplace totally flattened out. And this is where like traders, they start to get a little bit exhausted in there. All right, so let's start to look at some of the action. Just briefly look at some of the action over this past week, because if we drop into the SPX, the mother of all products, this is what I call, around the expected move and back again. Let's start with this. So this past Monday, it was the Monday after Easter, which is a holiday session in most parts of the world. Like most of the European markets were closed. Many of the Asian markets are closed too. So it was like a low liquidity, fierce sell-off though. Looking at this stuff in like past tense in the chart doesn't necessarily do it justice, but I want to bring it into scope because whatever you might think, look, we sold off from here down to here, and this expected move this week was plus or minus, 168 points. 168 points. So on Monday, you sell off over 160 points. You rally back up to some extent. We explode back on Tuesday. It's like, it didn't happen. It was a mulligan. So we had the mulligan of trades. And then we're massively unchanged in the week. Then you're coming into Wednesday, we explode, we hit the upper edge of the expected move, we pull back off of that. Thursday, we actually crack outside the expected move, and here we are on a Friday, which everything kind of mellowed out a little bit. Is that not enough of an explanation for you there? Okay, you just, again, you have to recognize when I call it expected move and back again, you're 170 points lower here, then you're 170 points higher here, all basically inside of 2 trading sessions. And yet in the midst of all of that, no matter how wild it kind of got, I actually want to show this because I think it's really important for you guys to kind of understand this. You look back over the last couple of days, you have to realize we literally adhered to the expected moves. So this is why I spend such ample time on these weekend updates talking about expected move, because look what occurred. Like, again, here's the upper, this is the start of the week, and the lower edge of the expected move. Remember, 168 points above, 168 points below. When we came out of the gate on Monday, it was like, oh, it was wild, it was this. We went right to the lower edge of the expected move, stopped on a dime, reversed off of it. We explode back up to unchanged. By Wednesday, we hit the upper edge of the expected move. I mean, it literally, then we resonated on the upper edge of the expected move, and I'm kind of scrolling through. We hit the upper edge of the expected move yet again on Thursday, and here we are on Friday. We are outside the expected move. The only thing unruly that's happened thus far is we're outside the expected move. But honestly, you got 20 minutes left, and we could pull right back into it. Why? I mean, look at the range again. Like, what's 70, 80 points amongst friends? It's still completely and utterly wild out there. And I want to use that term like wild or chaos because I want you to realize that the price action that you're seeing on the screen right now, this crap is far from normal. And it's, to see us hit the lower edge of an expected move and the upper edge of an expected move in the same week, that's actually not that unusual. What is unusual is that the expected move that it's doing it on is 168 points. You're like, 170 lower, then you flatten out, then 170 higher, and that happens basically inside of 2 or 3 trading days. That's enough to make even the most veteran of traders, completely nauseous. It's wild, and it is, and that's why I want to get that to you, because whatever you might think about this marketplace, it's going to rally, it's going to do this, it's going to do that. Whoa, calm down there, cowboy. If like you don't see the risk, I don't give a crap whether it's to the upside or the downside right now. Like read between the lines, okay? This is manic. And that's what I want people to understand, like if there's one, critical takeaway from this, like, whatever recovery this is, it's under fire. And we're going to talk about this in a moment. I think everybody here realizes you're one tweet away, just one tweet away from, unleashing unbearable amounts of volatility. Okay. And I'm even going to foreshadow right now. If you don't believe that, look at the SPX and go a week out. Right. I'm literally going to freeze the screen. At the end of the video, we'll also cover this. The expected move again for next week is still over $150. And we just came out of like a chaotic week of $168 expected move. And we're going to go back into another one. And there's some big earnings, but like right now, nobody seems to even care about earnings. Like Google is massively unchanged. Google looks like any other trading day. No one cares. They don't care. Right now, we're fixated. And we're not even fixating on any of the economic data. There was a consumer sentiment survey that came out. The consumer sentiment survey from the University of Michigan. It didn't even move markets. Nobody cared. Durable goods, who cares? It's past tense. No one cares about what happened yesterday. They all care about what's happening tomorrow. And you better keep that in mind, because when earnings come out, nobody cares what you did next quarter. What's the guidance? And most of them are like, I'm going to pull guidance. It's wild. It is. It really is wild. So as I was saying, around the move and back again. Now, the next thing we need to talk about, it all looks the same. A lot of times I get comments, people like shooting emails are like, you don't look at enough charts. Right now, I don't need to look at any charts because they all look basically the same. It's what I call, it's correlation. We are heavily correlated in the midst of volatility. And let me explain this. So I'm looking at the spiders right now. And when volatility first kicks off, there's some sectors that are down big, like what? Like tech was down really, really big. And there's some sectors that are kind of holding it together. And then all of a sudden, everybody kind of throws in the towel. And then as soon as you're into volatility, like a couple of weeks into it, everybody kind of throws in the towel and we start moving as a unit. And it's basically like this chart that you're seeing inside of the spiders right now, it's everywhere. I call it correlation is causation, because everything looks the same right now. Like I look around some of the usual suspects, and he goes to Amazon, that crap looks the same. And he goes to Nvidia, yeah, that crap looks the same. And then he goes to Netflix, oh, I found one that's different. I'm doing that on purpose just to make a quick point over here. And then he looks over at like JP Morgan, crap pretty much looks the same, but it's down today. Everything kind of looks the same. And to be honest, when you're thinking about taking risk right now, that risk is pretty much going to be what? In parallel, meaning that if I take risk in JP Morgan and all of a sudden a tweet comes out, it doesn't matter whether I'm bullish and bearish in JP Morgan, that tweet's going to impact it. Pretty much everything on this screen right now. And of course, somebody's going to write me, an email and be like, what about Bitcoin? All right, that one's bucked the trend. You got me on that one. It's kind of bucked the trend, but believe me, if we go into a crap fest once again, you're going to see that get pulled right along with it. Things like gold in here, even the volatility inside of gold. I mean, it's wild and extreme, even in the gold markets right now. But I wanted to start with, again, that everything kind of does look the same. your technicals and so forth. So I almost throw some of this like out the window. And we're going to talk about some of the trades that I've actually found where I think that there's going to be good opportunity here in the near future. So I'm less inclined to like go around the horn and like, well, let's look at the financials. Well, holy crap, the financials look a lot like what? Well, they look a lot like the spiders. Oh, by the way, that also looks a lot like the NASDAQ, right? But it also looks like, again, and Boeing has recovered a little bit more, but that's because of an earnings announcement. It just doesn't matter really where I go on the screen. There's a few odd products out, like stuff like Costco, but even Costco, when it hit the volatility patch, similar, just flattened out right now. Walmart, okay, yeah, similar, just kind of flattened out a little bit. Many of the products on your screen, though, look, okay, extraordinarily similar, okay, in context of we're kind of moving as a unit. When the volatility hits, like if I looked at right now, I mean, right now, the S&Ps, are they higher by 0.5%? This is a slop fest, though, right now. There's no engagement. Everybody's kind of waiting for what? They're waiting for the next tweet. They literally are, right? Waiting with bated breath. It's not going to be the next economic announcement because nobody cares. It's kind of ironic. I'm doing this for a long time, and normally on these weekend updates, I come forward and I look at the calendar and I'm like, well, look what's coming out this next week. Okay, I'm not sure any of it matters anymore. PMI manufacturing, not gonna work here anymore. The employment situation should bring some fun. Does anybody care? Okay, it's in past tense. That was last month. We were working last month. We might not be working next month if the tariffs continue. That's how the marketplace is viewing everything. Like, think about it, the employment situation. Yes, the markets will move a little bit on the employment situation. But again, that was last month. Okay, we want to know what the next month actually holds. And that's the open-endedness. And that's why I'm saying the market risk loom, which actually brings me to my very next thought. That is volatility. Notice anything weird about volatility. Okay, there's a lot of weird things like volatility. And this is where everybody's like, oh, the volatility is crushed down massively. I kind of disagree because I want to show you something that I've been looking at in volatility. All right, so the real chaos kind of hit markets and again, I'm just going to kind of zoom in on this. The real chaos hit markets on the 3rd into April 4th, right? So where was the VIX on the 3rd? Because we're all the way recovered from that. Like if you look at the S&Ps, here's the 3rd. This is the tariff chaos in here. We're having a good time. And all of a sudden we're right back, okay, to where kind of that chaos kind of started. So that goes back to like April 3rd, but I want you to look at volatility. Look at volatility in the same exact time frame. So here we are back on April 3rd, okay? And what's interesting about it is volatility is pretty much hanging out in the exact same area that it was back there. Once again, why do I care that it's, it's reverted all the way back down. Okay. No, it hasn't, because volatility has already seen this risk. It should actually be dramatically lower, and it's not. That's because it's not sounding, if you will, the all clear. We're not in the all clear, and we're still, okay, minimally, but we're still in a volatility backwardation. If I were to actually plot this on a chart, it would look something like what? Well, there's a product depth chart, and we can actually plot it on the chart. Looks exactly like this. Okay. What you're actually looking at is right here. This is a May volatility future, a June volatility future, a July volatility future, and an August volatility future. And what it means is you're actually plotting technically 4 different time frames of the same product, and they trade at different levels because volatility in May is considerably greater than volatility out in August. And that's it's a very weird concept because you're saying the risk is bigger in May. Why? Because the world is still on fire. And by August, we're hoping that the world kind of mellows out a little bit. So they actually assign more risk to May than they do August. And this is literally how backwardation kind of graphs out. What's also interesting is that June and July are actually pricing volatility identical. So there's a couple things that can be discerned from looking at this volatility backwardation. Number one, we're still in fits of rage, no question about it. Number two, okay, because these volatilities are effectively the same, they're like, no, this volatility is going to be rather prolonged, and we don't mellow out until literally August. So, and yes, this can definitely change. Okay, it's one tweet away from changing. But when you start looking at that, you start to actually read the vol like skew. You're like, oh, holy crap! That's exactly right. That's the reaction that you want to have, and that's why I'm saying, the recovery is still under fire. Okay, markets they may have rallied, but there's still like critical looming risks in here. And that's why I look at things like vol futures. I also looked at VVIX, and VVIX has actually come down nicely. Okay. That doesn't necessarily, though, sound the all clear. Once the VVIX drops below 110, okay, you're on the clock. And you got to give it, a couple of weeks, specifically the VVIX, because again, you're still on the clock for risks to actually abate. But most of the time, when you enter into heavy volatility, the VVIX really matters. When you're in prolonged volatility, the VVIX can kind of die out. And I need only actually point out, if you go back into a time frame, okay, like 2022, like obviously this was a heavy bear market year, and I'm just zooming in to 2022. What happened here is, in the beginning of the bear market, and then the VVIX kind of dropped out. And that's exactly what you'd expect, because what happens is everybody needs a hedge, and then they start to relinquish the hedge and just settle into the idea that, we're going to be hell in a handbasket for a period of time. We might be there right now in the VVIX. Like it's starting to calm down a little bit. So volatility, in my opinion, kind of holds tight. And I know that a lot of people are like, no, the volatility crushed down this week. It did come down, okay? But you ain't home yet. And you're still at the point to where that volatility had gapped higher. Look, volatility VIX at 25, still high on a relative basis, no question about that. All right, back to my point. You're one tweet away from what? Exactly, okay? The reason I want to talk about one tweet away, just for a moment, is that this dramatically impacts like how I am positioning myself right now, okay? I'm definitely taking positions, okay? I'm being very, very highly selective with what types of positions I'm taking. I'm predominantly using defined risk like in-out spreads and just taking some shots. I pulled off a nice profitable trade from Monday to Tuesday before Tesla's earnings came out. We took a nice bullish chunk out of that one. I'm going to talk about a few other trades, but I think that this is imperative. And the reason is, okay, I don't want to sugarcoat anything. I'm telling you right now, okay, one bad tweet comes out this weekend or on Monday during the trading session, China, takes a shot across the bow and fires another shot. And it's going to get ugly in there in a hurry. The administration tweets, okay, and you're 200-300 points upside down in moments, okay, there's no reason to have to substantiate that risk. I think you have to go out and you take decent positions, okay, get back, reduce risk, and take shots where appropriate. That's it. Like use defined risk spreads. There's no reason to substantiate. I think when people are like, oh, there's such a buying opportunity right now. Really? Where I don't really see that opportunity. What I do see right now is we're one tweet away. I don't care if I missed the upside. I don't care that we rallied, from we were down 168 points and then up 168 points. It's even more than that. It's like a 350 point move from low to high. I don't feel like I missed anything in that one. Okay. I want no part of it. It's not about being long or being short. Okay. It's about open-ended risk right now. Okay. And that's, as I said, you're kind of one tweet away. And there was one today, which actually caused markets to literally flatten out. I know it doesn't look like much, but we traded from basically 55 all the way back to 55.10, 45 points in a matter of a few minutes. Again, unquestionably, it's wild out there. Okay. I think that there's some short opportunities right now in markets. And I do actually want to bring this up. One of them to which I think is a pretty good short opportunity is take a look at like EEM. EEM has had a magnificent recovery. This is emerging markets. Okay. I'm just not going to buy into the idea. Like people are like, there's a recovery, and it's buy everything that's not in the US. And the recovery over here has been pretty spectacular, though, in emerging markets. This is actually an opportunity that I'm staging to actually execute into. But in emerging markets, I looked at FXI. FXI is obviously the Chinese large cap. Some people are like, they're going to delist shares in here. If they do delist them, and I'm short, that's probably going to help me in some respects because before they delisted anything, this thing would actually sell off. But if you're concerned about that, use the EEM. EEM is very heavily into Asian markets. And if any of these tariffs actually persist, like how are the Asian markets recovering? How is anything recovering right now? You have to realize I look at this, okay, try to be as objective as I can, but I look at this, I'm sorry, that's a bear market rally. That's in my opinion, this is a bear market rally because nothing has really changed in recent trading sessions other than people are settling into the idea that these tariffs, they may be here, might be here for a while. Another opportunity I actually see is in Wells Fargo. Wells Fargo has had this rip and bounce from its earnings, along with many of the other financials. However, Wells Fargo has actually outperformed many of the other financials on a year-to-date basis, at least the big ones. This one is massively unchanged in the year. This one I actually did execute into a position. Next on the docket over here is the bonds. Okay, the bonds, after staging just wild sell side activity, they've had a bid back, another bid back over here. Okay, a little bit further up from here, and I think there's a opportunity also to short into the bonds. So I hate to be outright bearish on you in a couple of different products, but I mean that's the opportunity. It's really hard right now, okay, to want to jump on like alongside of this marketplace. Like, could there still be upside potential? Yes, we're looking at the Nasdaq, but could there be some upside potential in the Nasdaq over here? Absolutely, unequivocally, yes. Okay. But at this point with the news cycle, like I just think the news cycle right now, it's just a merry-go-round of risks. There's going to be tariffs and there's going to be Fed, and then the administration comes out and calms everybody down. But then there's tariffs and there's the Fed again, and the Fed isn't doing anything, and then there's tariffs, and then and then oh no, what about earnings? There's no guidance out there. Oh my! So I think that these significant the bid back onto the marketplace is opportunistic for a short, and I'm not sure I can time them perfectly, but we're going to do a pretty good job of it anyway. Short opportunities are in front of you. Last but definitely not least, we come back again to the SPX. As I said, the SPX this last week, big boy expected move, $168 expected move. Now, we rallied. And most of the time when you rally, what happens to volatility? And this is another critical point to be made. Look at this. We're rallying into the close here, right? Another critical point to be made. So when you rally, you see volatility falling, except you don't see some of the short-term volatility falling. If volatility was falling, we just went, from 168-point move. Now, granted, we just, came off of this full trading week, and it's, whatever, Monday kind of felt a little bit like a holiday, but it was still a 170-point move to the downside. But what the point that I'm trying to make is that you're coming into another week with a $150 expected move. And, people, that is substantial. That's just a really substantial move once again. So strap in, people. This volatility is far from over. So I was saying to begin with, the recovery, it's there, but that market rally still got looming risks. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.